over the last year, I looked at over 84 deals that we sold on the Empire Flippers marketplace, and I realized that 85.7% of them actually sell for less than what we were listing at. Now, this is no great shocker to me. This is something that happens. The average discount that we're seeing right now is about 18.2%. Now, that's not true for all businesses, and we are currently in a bit of a softer market, but I thought it would be a good video to talk about why did businesses sell for less? Why do they get negotiated? Are these discounts coming from? Are they justified? And how you can try to avoid them when it comes to you selling your business for hopefully the maximum price possible. So first, let's talk a little bit about a pricing myth here that some entrepreneurs have. One, extremely common, as I repeat all the time on this channel, that sellers, entrepreneurs, is very common for them to overvalue what they built. They'll overprice it, think they're worth a lot more than they actually are. This is very, very common simply because they haven't seen deal flow like what we have. Like, we've sold over 2,400 businesses. We have a pretty good grasp on what something is going to get priced at, what it should be listed at, all that kind of good stuff. And even so, we still get discounted. So what is happening here? Why are most businesses getting this 18% discount and only 2.4% businesses ever sell above asking price? And how can you be that person that sells above that asking price? Well, it comes down to these discounts, how they happen. It comes down to the power of your negotiations, what kind of leverage you have, the psychology, and of course, the positioning of your business. So let's get into what I call the initial offer trap. So the initial offer trap honestly usually starts with the broker, funny enough. So we at Empire Flippers, a lot of times we will lose a deal that could have been on our marketplace because an entrepreneur says, well, this person, broker XYZ over here, is going to give me a way better multiple than you guys. And usually what that means is that that broker is going to get you to sign a 6-month exclusivity with them. And once you have it signed, you can't go anywhere else but that broker. They will start whittling you down to reality. Versus Empire Flippers, we start with reality, like, hey, we've sold a lot of businesses based on our data, based on what your business is. This is what we think the fair market value is. And we will try to pump it up just a little bit because we know that we need to bake in this discount. So we will try to basically reverse psychology the buyer on it because we know the buyer is going to negotiate, right? So we want to bake that into your valuation, but we also don't want your valuation to be in fantasy land, right? Because that's going to turn off buyers. It's going to turn off the momentum you can have to have multiple buyers competing against each other for your business. It's extremely important you have multiple buyers that are looking at your business at any given time before you enter exclusive due diligence, that is. On our marketplace, the average amount of NDAs every business gets is roughly around 81 unlocks, 81 NDAs, 81 different buyers for every listing that goes live on our marketplace. Now, this is really, really good for you because, as they say, like, if you have business problems, get more leads, because the leads usually solves the problem, right? It's much better for you to be in a position where you have 81 people looking at your business versus only one. Because if there's only one, especially if that person knows there's only one, then they know they have much more leverage to get you probably for a lower price. Versus if that buyer knows, like, hey, it's a bit of a feeding frenzy in here because Empire Flippers created this market around your listing. Now this is going to be a very different type of flow, right? 81 different buyers competing against each other will naturally bring your price up and lower the ultimate discount that you may end up having to negotiate and walking away with. Now, a thing that buyers will often do, and this is, again, some criticism that we get of why someone chooses not to go with us, is they might get hit up by a buyer who offers them the world. Like, well, why would I go with Empire Flippers giving me such a low multiple when I can go with this guy who just randomly appeared in my email offering to buy my business for much higher? This is also part of the initial offer trap. What's happening here is the buyer's opening it up with what you probably want, and they're going to assign, say, the NDA, letter of intent, all that kind of good stuff. But the letter of intent, that is usually not binding that they are going to go into the deal. Usually they are interested at the offer price that you want based on an addendum to what they find during due diligence. And so really, I don't view the LOI as an offer at all, but a lot of newbie sellers, they do. They think LOI is an offer, which it is not. It is the opening salvo for the discussions for the buyer to start doing due diligence. Once they're done with the due diligence, that's what, in my opinion, is the real first offer, because now their offer is based on them being informed on what your business is all about. And this is really where you start seeing the discounts come into play, because a savvy business buyer is going to be using all the due diligence basically against you, right? They're going to be justifying that offer that they are going to give you based on what they find in this due diligence. So it's kind of a bit of asymmetry that the buyer has over you. This is often why I say buyers are sometimes in an advantageous position when it comes to negotiations versus you, because they see everything about your business, right? They literally have to in order to feel comfortable by your business, but you don't get to see everything that they're doing. So it's kind of a game where you're playing a bit at a disadvantage. Plus, usually buyers, they tend to have bought before, so they tend to know how to do a deal, all that kind of stuff, versus sellers, usually it's their first time ever doing a deal, right? So with this information asymmetry, it gives them negotiation leverage where they can justify that discount. And often they're right. Like, there's often problems in businesses that would justify this discount that they'll end up finding during due diligence. And part of the game of actually doing a successful transaction, which I'll get into more here in a second, it's not like pushing back so hard where there's no discount, but rather coming together where the discount becomes lower, where you assuage their fears, but you still say like, hey, I get it, but I think it's still at this price because of XYZ, right? You need to justify it as well. Now, the other thing is transaction psychology. So because sellers are emotionally invested in their business, again, that emotional equity thing, which usually leads to overvaluing, that can often lead to weaker negotiating positions. So as I said, that buyer is going to come to you after the LOI sign with the first real offer, which is going to be lower than the LOI. It's almost always lower, very rare is ever going to match up. And they're going to justify that discount with their DD stuff. But you need to counter offer that if you want a higher price at least, and you need to justify that counter offer. Now, the issue that sellers run into is because they're emotionally invested into the business, they are not really justifying anything. They're just saying no. Like, you gave $1 million offer, I want 1.2 million. No rationale behind it. Like, the buyer's like, why should I give an extra $200,000? Here's like my structure for $1 million where it makes sense. Tell me why your business is worth 1.2 million. And the buyer's totally justified in saying that. You need to explain why your business deserves that extra 200K. Now, if you're using a broker like us, we can help you do that, massage that message, and help you justify that counter offer, of course. But this is a big reason why sellers end up selling for less. And in fact, if the seller doesn't have a breaker, it's usually much worse because the seller doesn't know how to do a proper counter offer. So they might start off thinking their business is worth a crazy high amount. The buyer gives this offer down here, like, oh my God, they're lowballing me. No way. So the buyer goes away. You can't find another buyer. You come back to the buyer. Now the price is even lower and they just wear you down. And because you also don't know what the true value is, because you're only basically taking this buyer's word for it, you'll often end up selling for way less than what you would sell with someone like us, even after you take in our commission. So even after we take the commission out of what you get paid, you will often get paid more by using us. We went private for all of these reasons. And of course, there's market expectations. So every buyer wants a good deal, right? They're incentivized to do this. So they expect to pay less than the listing price in all but the rarest of deals. Like, I've definitely seen deals where buyers don't do this, but by the nature of them putting the risk at the table, like their debt stack, their money, their own capital, whatever, they expect to be able to get a deal. It's very important from your perspective to be able to feed that, like feed their ego a little bit, help them see that they do get a deal. Even if your counter offer is higher than their offer, you can still position it as a great deal. And ethically, it should be. Like I always say, buyers should ethically want to give you a reasonable, realistic, good sum of money for what you built. And you ethically should want to give that buyer a reasonable, good deal where they can make money from the money that they're putting in. You don't want the buyer to overpay. And often buyers and sellers become friends and partners on a lot of different things. So you want to have a good deal where it's a win-win all around the table. Now let's talk about how do you go the other way? If most businesses get a discount, what are the things that are making some businesses, a very small minority, actually sell above listing price? And there are things, right? There are things for it. One, like maybe we didn't see those things when we valued it, and it comes to the table when we see the buyer feeding frenzy we've created for you. And so you start having these buyers compete against each other more. But usually the traits of a business that's going to sell over a listing price on EF, at least, it's going to come down to three main things. The first one is operational excellence. So you have extremely good, clean financial books, usually done by an actual trained accountant, not just what EF can do for you, but an actual accountant. You have clear documentation of how everything works in your business, your org chart, all that kind of stuff. Clear documentation of each employee, how good or how bad they are, KPIs, all that kind of stuff, and then systems that you plug into all that documentation, or rather the documentation is plugged into those systems. And ideally those systems are set up in such a way where you yourself, as I always say, are the most useless person on your own team, because the systems take care of all the leverage, right? They're doing everything for you for the most part, where it doesn't really require you. And the more you have these three things, the more operational excellence you will build in the buyer's mind, which of course makes them want to acquire you more, because this sounds awesome, right? Oh, this guy has it all figured out, right? Of course I'm going to pay a premium for that. That sounds great, because buyers are willing to pay premium. They're willing to pay over a premium as long as the business itself can justify as to why they should pay that premium. So that's up to you. You got to make sure the business actually warrants that. Now, speaking of warranting that is growth potential. A lot of people, it will come to me when their business is declining. This is a bad time to sell. Like, we can still sell them. We sell declining businesses all the time, but you're not going to get as good as a multiple as you thought. But if you want to get the best possible multiple, you need to be able to make the case for growth and how there's a lot more potential left on the table. The best way to do that is not telling them it exists, but rather showing them it exists by looking at your P&L, looking at your traffic numbers, looking at your client acquisition, and seeing that number ticking up percentage-wise year over year. You want to show 3 years of solid growth where it doesn't look like it's really slowing down. And so that means you're not selling at the peak. You're selling on the way up to the peak. You're going to allow the buyer, if they move fast, to get to that peak. That's the important difference here. A lot of people think that they want to sell at the top of their business, which yes, you can, but that's a harder place to sell than if you're on the way up on the mountain. You want to sell on the way up, not when you're at the top. Finally, it's competitive positioning. You know, if you are a dropshipping store, like you might be making like 30, 35K a month, but if someone can just look at your dropshipping store, get a Shopify account, look at your meta ads library, and get basically the exact same product that they're promoting up within a few days, you don't really have a defensible competitive positioning. And what makes your business unique? What makes it hard for someone to come and just do what you're doing in a week, right? There's got to be something there, some kind of moat that is really, really powerful. So like with an agency friend that I'm helping with, he's doing crazy good paid client acquisition, which is actually quite rare with a lot of agencies. They don't usually perform that well. They're usually very heavily reliant on referrals. But because he has this entire system, not just a marketing system, but also a sales system set up that is running in the background, humming like a well-oiled machine, this is extremely defensible. This is very tough to recreate unless you really see how the engine works by basically being the owner of the business, right? So you want to ask yourself, what are my competitive moats that make it very difficult for a copycat to come in and just do what I'm doing? So that's how you can sell above list price, right? And also defend against the discount too, right? But we also want to be careful here of some very common mistakes that sellers make that I have seen over hundreds of deals we've done at Empire Flippers. And the first one is not being proactive enough with your disclosure. And what I mean by this is an entrepreneur is likely to hide, like not nefariously, just maybe they're embarrassed or they think it will kill the deal. They tend to hide all these big mistakes in their business. But the thing is, the buyer's going to figure it out anyways. At least if the buyer's worth their salt and they're doing good due diligence, they're going to find those mistakes. So it's better that you control the message, you control the narrative. When you see these big drops in traffic, try to figure out what happened there, or you lost some important clients, figure out what happened there and tell the buyer up front before they ever discover it. Let them know what happened, how you're fixing it, or how that solution is now going now that you fixed that problem. And that puts a bunch of confidence in the buyer that like, hey, this guy is like really clued in, right? This is like, I didn't realize that I was there yet until you told me. Like, I think it was probably going to find out, right? And if you have a mistake in your business or a failure, that's not the end of the world. In fact, a lot of times your failure in your own business is the buyer's opportunity. Like, we spent all this money on Facebook ads. It just didn't work out. Couldn't do it all. That buyer happens to be a ninja with Facebook ads. It's taken like, an afternoon going through your account to see what you were doing wrong, right? So this now becomes a massive opportunity for him in his own mind. Now, when it comes to this, you don't want to position it that way. You want to position it what it is, which is your mistake, right? Or your failure, or just didn't work out as you thought. And by doing it that way, instead of saying like, oh, this is your opportunity, right? By doing it this way, we're allowing the buyer to create the opportunity in their own mind where they're selling themselves on the business. you're not promising them anything. You're telling them, hey, look, I made this mistake over here, right? So be proactive in disclosing any kind of problems, what your reaction or fixes to those problems were. Next is realistic pricing, which I already gone over a bit, but again, you want to be valuing your business based on comparables. Talk to an actual broker who sold deals like yours. You want your valuation to be premium, but not unrealistic. If you value your business at some like fantasy number, no serious buyer is going to look at you. They're going to be turned off just by you doing that pricing out of the gate. Might turn off the buyers that could make you into a multi-millionaire. If you had just been more realistic with price, you can still go premium, nothing wrong with that to try to get that evaluation, but we want to be realistic with our price. Next is preparation depth. I often talk about being prepared as one of the key factors to selling your business fast. And if you have tons of preparation, like these problems, if you have entire written analysis of like what you were doing, how you fixed it, all that kind of stuff, and for any other kind of due diligence question that might come up, you have written explanations or at least are well prepared on how to handle that question. This is great because the buyer gets the feedback they need super quick, keeps the momentum going. They don't have to wait 2 weeks for you to dig through your financials to find this like specific report for them. If you just have it, that allows the deal to have a good flow, good momentum, and ultimately help you get to that finish line where you can get this, life-changing amount of money. All right, so now you know why businesses tend to get discounts, how to get a premium, and how to avoid some seller mistakes. Let me tell you the most important part though. If you want to sell your business and don't want to make any mistakes, all you got to do is click the link down below and start the selling process with us over at Empire Flippers. We've made 90 millionaires at the moment of this recording. Maybe you'll be 91. Talk to you soon.